Hi everybody. Okay, so this tutorial is kind of going over some of the key elements when we talk about cost behavior analysis or CVP analysis. So we've been talking about the various cost classifications. So we started off with straightforward product and period, and then we moved into looking at variable and fixed, and we're introducing a mixed now. We've talked about the job order costing. We've talked about the movement of costs from inventory accounts onto cost of goods manufactured, and then lastly onto cost of goods sold. And now we're going to take a little bit of a break from that aspect and introduce something new. So CVP analysis is really kind of like trying to understand, the costs within your company and how changes in those costs or changes in production or changes in sales or anticipated sales can impact the company negatively. Okay, and what's the value of doing this type of analysis? Well, it's if we don't take the time to complete our break-even analysis or margin of safety, or try to figure out our target profit levels, contribution margin, we really lose the ability to be able to try to control our expenses. And by doing this analysis, we get this visual access, I guess, to information that allows us to see, for example, if our contribution margins are decreasing, month over month, then we're able to see that there's clearly an issue, with our variable costs, right? And then make changes to the business, make changes to suppliers, make changes to the elements that are impacted in variable cost in order to get that contribution margin back on track. Performing an analysis like break-even analysis, obviously it allows us to be able to determine what that minimum level of sales in dollars or in units that we need in order to make sure that at minimum we break even. Okay, that shouldn't be obviously your top end goal, but at a minimum you would want to make sure that you're selling enough to break even so that you're not in a loss position. Okay, we start to look at a clear, distinct breakout of our costs. We look at variable costs on the top end, okay, to determine our contribution margin, and then fixed expenses after contribution margin. We always want to make sure, the goal is that we always want to make sure that we have enough contribution margin dollars to cover our fixed expenses. Okay, because we have no control over those fixed expenses. That is the nature of fixed expenses. They're static, they will remain throughout. And if we don't have enough contribution margin to cover that, then we're going to have an operating loss. Okay, we're not going to have a profit for that period. Okay, so I'm going to just run through a couple of examples, and we'll go from there. So in this first example number 1, it says a market survey for a new gizmo indicates that the product can be sold at $40 per unit. The fixed costs for the period are $84.30, and the variable expenses are $25 per unit. Production capacity per period is 850 units. Perform a break-even analysis and find 1, the equations for total revenue and total cost, 2, the break-even points in units, and 3, the break-even point in dollars. Okay, so there's a little bit of algebra that you're going to have to go back in time, make sure you understand to be able to complete these problems. So for part 1, we want to figure out the equations for total revenue and total cost. Okay, so total revenue is equal to price times quantity. Okay, very straightforward. Our total revenue is however many units we've sold at whatever price we've set. Okay, total cost is our fixed cost, so FC is fixed cost, VC is variable cost, and then multiply that by Q, the quantity that has been produced or sold. Fixed costs are given at $84.30, and the variable cost per unit is $25, which is given. Okay, so we have our equation Okay, this is going to repeat throughout, so make sure you understand. To determine what our total cost is, it is 84.30 plus 25 multiplied by the quantity. Okay, so that's the answer to part 1. That is your formula that you need in order to determine your total cost. Okay, part 2 is, okay, so we have our elements. We have the selling price, we have a variable cost, and we have our fixed costs for the periods. Now we need to be able to figure out what is our break-even point. Okay, so we're down here. So at the break-even point, okay, straightforward thinking, break-even, our total revenues will equal our total cost. When you subtract the two, you end up at 0. We haven't made money, we haven't lost money. Okay, so using the formula, okay, if we know that 40 is our selling price, multiply it by Q, our quantity, we're trying to figure out Q, is equal to 84.30, so our fixed cost, plus 25, our variable cost, times quantity. Okay, now back to old school algebra. Okay, the 84.30 remains on the right. We need to move the 25 and the Q to the left side, and when you move it over to the left side, we subtract 25 from the 40, you end up at 15Q. Okay, solving for Q means then we take 8,430 and divide it by 15 to get 562 units. Okay, if we sell 562 units, we will have 0 profit. That is our break-even point. Okay, now we want to know what that means in terms of dollars. Because we have the units, all we have to do is a little bit of substitution into either formula. So you can either enter it into the formula for total revenue, okay, 40 times Q, or into the total cost formula, because remember, total revenue equals total cost at break even. So either one of these formulas will give you the correct dollar amount. Okay, so solving into TR equals $40 times 562 units equals 22,480. If you're unsure, you test it in the second equation, 84.30 plus 25 multiplied by 562. Remember the rules of bed math. You do your bracket first. Okay, so 25 times 562 and add that to 84.30 and you'll get 22,480. Okay, so if you have so now you have your measure for break even in units or dollars. We need to sell $22,480 worth of goods to break even, or 562 units. Okay, that's the interpretation of break even analysis. Okay, and I'll just read for you this part here. In some cases, you may be given a question in total sales dollars rather than unit prices, and in this case, we assume that our output is sold in $1 increments and proceed. Total revenues or sales will be given as 1 multiplied by Q or simply Q. Fixed costs will remain the same. Variable costs are directly related to sales volume. Both depend on quantity. So if we take total variable cost divided by total sales, this will give us the fraction of every dollar of sales that goes to variable costs or unit costs. And this is just to let you know that depending on how the information is presented to you, here it's given to you by unit, but if it's given to you in total dollars, okay, then you just have to break down the information to get your a ratio or a percentage and apply it the same way in the formula, and I will show you an example so that this makes clearer sense. Okay, example number 2. Okay, this is an example where instead of the per unit, we have the we're going to have the total amounts, and then we figure out the percentages ourselves. Okay, so example number 2 says the following information is found in the accounting records of Acme Co. Fixed costs for the period are $7,200. Remember, fixed costs don't change. Variable costs, they change with the amount of units that are produced and sold. Okay, sales volume for the last period was 29,040 and variable costs were 17,424. The capacity per period is a sales volume of 35,000. Find the break-even point in dollars and as a percent of capacity. All right, so the formulas. unchanged. The key difference here is that, I'm just trying to see if I can do some color changes or something here. So the key change here is that because we don't have the per unit, okay, we have the totals, we just have to find a percentage ourselves, okay? So 7,200 is given, all right? So then we do plus bracket. We take our variable cost, TVC, total variable cost, divide it by our sales given to us, 29,000, close bracket, and multiply by Q. 17,424 divided by 29,000 is 0.60, okay? So 7,200 plus 0.60 times Q. So then we, following the same formula that we looked at in example 1, all right, we move Q to the left. Quantity equals 7,200 plus 0.60 times Q. 0.40 is the difference between, let me show you something, is the difference between 100%, okay, so 100% of your cost, less 60%, which is applied to variable cost, you have 40% remaining, okay? So, you know, there's an imaginary 1 in front of this Q, okay? So 1 minus 0.60 is 0.40 Q. We want to solve for Q. We divide 7,200 by 0.40, and we get 18,000 as our quantity, as our dollars. In dollars, the break-even point will be $18,000, okay? So the key here, when we don't have, when we're given the total cost instead of the per unit cost, is that you have to remember that there's this imaginary 1 here, okay? Following an algebra, there's a 1. In order to remove the 0.60 from the far right side of the equation, we subtract the 0.60 from the 1 to get the 0.40, okay? And then we isolate Q by dividing 7,200 by the 0.40. When you have to find the break-even point as a percent of capacity, the capacity, whether in dollars or quantity, is given in the question. So we're told here that the capacity for this company is a sales volume of $35,000. They cannot exceed $35,000 in sales. They can't support it, okay? So choose the break-even point in units that match the capacity, units, and divide. So the break-even percentage capacity is equal to our break-even in dollars divided by our capacity in dollars. So the break-even point here will be 18,000 divided by the 35,000 given in the question. We have a break-even point of 51.4% of capacity, okay? So, when you're looking at this for the first time, obviously, the algebra might, is a little bit tricky sometimes. I know that. But, what is critical, okay, is that you understand how the formulas work, that, we're looking at variable costs in conjunction to sales, okay, and when we look at contribution margin, this will also make more sense. Fixed costs are standalone. They do not change. They're not a function of sales. Okay, so they're always going to be standalone in any of the equations. That when we're solving for the quantity or the dollar, whether in units or dollars, we have to make sure we isolate Q in order to be able to complete the equation. Okay. So once you do these questions a couple of times, they become much more familiar and less overwhelming. So certainly an area where practice makes perfect, okay? But these are some great, simple, straightforward examples. Let's talk a little bit about contribution margin, okay? So in traditional financial accounting, when we look at an income statement, right, we have revenue on the top line, we might have cost of goods sold, and then we get a gross profit, and then we have our operating expenses, and then our net income. So in the cost accounting environment, we change things up because we're so heavily focused on controlling those costs and making sure that we've analyzed those costs to the fullest possible extent that we can, and that we really understand them. So we kind of shift focus on number one, how we present the income statement. It changes, and we'll look at an example of what a contribution margin format income statement is. But then also just in paying attention to this specific this number or ratio of contribution margin, because it becomes critical, like I said before, to make sure that we have enough contribution margin to cover those fixed expenses, or else we'll know right away that we're going to end up in a loss position. Okay. So the contribution margin is the difference between the selling price and the variable cost, regardless of whether they are given as unit prices or total dollars. But what does the contribution margin mean? It is how much money is left over after variable costs are paid to contribute toward fixed costs and profit. Okay, such a straightforward definition that I like to find things that really just kind of simplify and make it resonate with you guys. Okay, it is the amount of dollars that are left to contribute towards covering your fixed costs. Okay, straightforward formula. Contribution margin equals your price minus your variable cost. Okay, for a problem with unit price given, find the contribution margin per unit. In the case where the problem gives you total sales dollar and total variable cost, the contribution margin is given as follows. Okay, so kind of like in the example that we just did, you'll either be given price is 100, variable cost is 25, or you'll be given it in total dollars, and it's just 1 minus your variable cost divided by your sales, and then you'll get your rate, and 1 minus your rate, that will give you your contribution rate. Okay, the contribution rate is the contribution margin expressed as a percentage of selling price. So for problems with per unit prices given, your contribution rate is equal to your contribution margin divided by your price multiplied by 100%. And we're going to do examples. So like I said, the more you do, the more it visually makes sense. For problems with total sales dollar, the contribution rate is equal to your contribution margin times 100%, because the contribution margin is already expressed as a fraction of the sales. So now let's put this into practice. A games dealer has the following data in her operating budget. Sales were $1,020,000 with fixed costs for the periods of $160,000. The total variable cost was $581,400. Find the contribution margin, contribution rate, and break-even point in sales. This is a total sales dollar problem, so recalling that price per unit is assumed to be $1, and that the variable costs are expressed as total variable cost divided by sales. So our contribution margin is 1 minus total variable cost divided by sales. So it's 581,400 divided by 1,020,000, which would be probably 0.57. So 1 minus 0.57 will give you a contribution margin rate of 0.43. The contribution rate is the contribution margin as a percentage of the selling price. So contribution rate is 43%. Okay, we have 43% remaining to cover our fixed expenses. 43% of the selling price. That's what we're figuring out here. Okay, and if you see, if we have 43% this month, if we had 40% last month, and this month we have 43%, it means that we're gaining efficiency, because now we have 3% more margin to cover our fixed expenses. Conversely, if we had 57% contribution rate last month, and now we have 43%, that means we lost 6% in some gap in the variable costs. Okay, so it means that there's some type of leakage, there's some type of issue or inefficiency that's causing our variable costs to increase. Okay, so that's how you read this number. You would follow this number period over period. In the ideal world, if you're happy with all your variables, with your sales price and your sales and whatnot, you would want to see this contribution rate remain as static, or as the same level as possible. follow, if it's continually going up and down, it means that you really don't have a good grasp or handle on controlling your costs. And that's what this analysis lets you see. How are we able to control? Are we able to control our costs? Have we been doing a good job? So the more variability that you see, the worse that it is. Okay. And the last part here, the break-even sales dollars, is equal to your fixed cost divided by your contribution margin. Okay, so 160,000, which was given, divided by 0.43, we need to have sales of $370,093 in order just to break even. Okay, so hopefully, these examples are, like I said, straightforward, just, as your basic start off point to introduce you to these concepts. But the more practice we're able to do, the better. I put in this little note that I wanted to make, hopefully, you did the readings, extra readings if you found them, great. We have to remember something about fixed costs and variable costs. Remember that fixed costs do not change. Variable costs, they will change with quantity levels, okay? If fixed costs or variable costs or selling price of an item changes, this will obviously affect the relationship between total revenue and total cost. Okay, so what you have to also remember is that when you're doing this analysis, if you've changed something from one period to the next, it will change your break-even units. So you have to really pay close attention to these to the variables that you're using, because if total variable cost, your fixed costs for some reason are going to change the next period, and you don't incorporate that into the next period's break-even analysis, and you use your old number, your break-even units or your break-even dollars are going to be wrong. Okay, so you have to make sure that any changes are incorporated into your calculation. You can't assume that they will remain static. Okay, because using old data will cause you to make mistakes, okay, and run into a situation where you didn't sell enough, and then you're going to lose money. Okay, so for instance, in the break-even analysis, if the fixed cost increase, the number of products sold to break even must also increase, which should be logical. Okay, if our fixed costs are increasing, then we're going to need more units sold in order to cover those costs. We need more contribution margin to cover our fixed costs. Okay, when you think of these topics, I always say just take the most real life, straightforward approach in thinking. Okay, if we're increasing fixed costs, then logically we're going to need to sell more in order to cover those costs. Okay. And conversely, if the selling price of an item decreases, the break-even quantity will also decrease. Okay? Not selling quantity, the selling price. If we've reduced our price, then that also impacts our break-even quantity. To determine a profit or loss other than zero, we rearrange the equation to, so this is what we call target profits. Okay? If you need to figure out how much if we want to figure out how to determine a profit or loss, if we want this number to be 1,000, then we can, just rejig our total revenue minus our total cost to equal 1,000. And this allows us to continue to analyze how changes in the selling price or fixed costs or variable costs will affect the profit or loss for the business, right? So we're always working with budgets here, so we can enter, our budgeted revenue for the period and our total cost for the period to determine, what our anticipated profits or loss are going to be. Cost accounting is heavily based on, it's all based on budgets. So we can, do these scenarios where we, input these variables into these equations to get a rough idea of where we anticipate our profit and loss to be. Okay, and that's the whole point and exercise of looking at the costs, variable, fixed, and doing all this back end extra costing work, is so that we can be able to create these budgets based on these equations and, do our best to try to stick to them and monitor them as the periods go on. Okay, and here is a example that I wanted to run through with you guys. So I'm going to just bring it up as we go through. So the operating budget of Honeybee Company is given as follows. So this is, an example where they're not giving us our sales or our variable cost by unit. They're giving it to us in total dollars. So we know that we have to use the formulas that we're determining the percentages ourselves. Okay. So here's our sales, our fixed costs, our variable cost, total cost, and the sales dollars at capacity amount. So the first part is determine the contribution margin and the contribution rate. Okay, so how do we do that? Remember, contribution margin is equal to our sales minus our variable costs. So very straightforward, 425,000 minus 255,000. Okay, so that's the key. If you're given a question, for testing, make sure that you're picking up the right amounts, okay? Doesn't matter how it's listed, you have to pay attention that you understand contribution margin is a function of sales minus variable costs, okay? We get 170,000, and then we have to figure out what is the percentage of variable costs out of sales, and we get 0.40. So our contribution margin is 0.40. To figure out what the contribution rate is, very straightforward. It's the 0.40 multiplied by 140%. Very straightforward. The next part, calculate the break-even point in dollars. All right, so we have our formula, total revenue equals Q, total cost equals fixed cost plus total variable cost divided by sales multiplied by Q. Okay, so our total cost is 122, which is our fixed, okay, plus the 255 variable cost divided by 425,000 multiplied by Q. So it's 122,000 plus 0.60. 255 divided by 425 is 0.60 multiplied by Q. We need to move the 0.60 Q to the left, so we do so. Remember, there's an imaginary 1 on the left side, so 1 minus 0.60 leaves you with 0.40. Q equals 122,000. Solving for Q, we divide 122,000 by 0.40, and we get $305,000. Okay, we need to sell $305,000 worth of units in order to break even. What is the part 2 is the capacity. What is the break-even percentage as of capacity? And they tell us that our sales dollar capacity is 531,250. So we take the 305 from part 1 and you divide it by the 531,250, 57.41%. That's our break-even percentage of capacity. Okay. And then lastly, okay, so now here's where we show you about the relationship. What happens when one of these variables change? And this is, the most critical part of, this whole cost volume profit analysis is, being able to do these basic calculations. They give us the numbers, we put them into the equations, we solve. But what happens when the variables change? And this is what cost accountants are continually looking at. Okay, this is, the real life part. Okay, so part C, determine the break-even point in dollars if the fixed costs are reduced by 12,100 while variable costs are changed to 68% of sales. Okay, so they tell us that our 122 reduces by 12,100. So our new fixed cost is 109,900. The next part is we're told that now variable costs are 68%. Okay, so it was 60 to begin, but now we're at 68. Okay, so you just change your formula. Again, we need to move the 0.68Q to the left, imaginary 1 on the left, minus 0.68 gives us 0.32Q. Solving for Q by dividing 109,900 divided by 0.32, our break even in dollars is now 343,438. Okay, our variable cost element went up, so our contribution margin went down, and our fixed costs also went down. So we need to sell more to offset the fact that our variable cost has gone up. Okay, so just the most straightforward example of what happens when one of your variables change. Okay, and the key for you guys to remember for your homework questions or for exam purposes is that you make the changes throughout the formula. Okay, don't get stuck and leave 122 in one of the lines, or don't change your 0.68 from 0.60. Make sure you make all the necessary changes to get that right answer. Okay, guys? So these are your straightforward examples on cost, volume, profit analysis, break-even analysis, contribution margin, contribution rate, and what happens when some of your variables change. So hopefully this helps you to guide you through the assignment, and good luck to everybody. Thank you.